Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Okay, welcome everybody. Today we have a very special podcast. It's the first time that we actually have a guest speaker. We will continue doing our normal format on Wednesdays with our commodity owners, but today we have a great guest, Mads Frank, who currently works at CM Navigator, but also has a dual role with Navy Merchant. We're obviously going to discuss about freight with Mads, but before I ask you to introduce yourself, let me also introduce the rest of the team. So we also have Michael Ryan, who's our freight guru. Hi, Michael. How are you?
Hey, good. Thanks. Good to be here.
Excellent to have you. And Neil as well, of course. How are you, Neil, today?
Very good, thank you. I know the least about freight on this group of people, so it's good to have a village idiot amongst you, I suppose.
Yeah, I mean, definitely you and I are going to be sort of sitting back on our chair with popcorn and listening to these two guys talk about freight, as we have very little to add. But you know what? Maybe that's the point. Maybe the point is to ask questions and learn something new today.
Yeah, please do.
Mads, maybe you can introduce yourself and tell us a bit more about yourself.
My name is Mads Frank. I work for Danish ship owner Navy Merchants, but I also work for a software as a service called CM Navigator, where we build freight models for the dry bulk space, which is sort of how I bumped into you guys. I used to be a freight trader for 10 years, most notably with Louis Dreyfus in Switzerland. I think today will be interesting for all parts. I don't know much about the oil markets, so I'm quite curious also to actually see what wisdom Michael can teach us or teach me as well.
Excellent. Well, look, I'm going to completely go off script from the first moment. I'd like to learn, how did you end up in the shipping industry? Tell us a bit more. What was that first job that got you into shipping?
It's actually a good story. My mom and dad actually went both sailing for Maersk. My dad had been a chief engineer for 15 years. My mom was not on a gap year, but let's say she wanted to do something else. And back then they had stewardesses on board vessels. So she took a 3 months rotation, ended up meeting my dad. Quite amazing. Of course, he had to go home and divorce his first wife. That was not so good. But it was good for me because a year later I came into the world. And then there was always this, let's say, mythology around shipping in my family. And when you're from Denmark, it's a national pride. We have Maersk, we have a lot of shipping lines. Then when I was finishing my studies, I applied to become a shipbroker. And I had written my application and I was like, I've done all this work, I've written the application. Let me send it to 10 other companies because they were all searching for trainees at the same date. So I thought, okay, I just change the name, I apply. I went into talks with, I think, 5 of them, go through the IQ testing. And in the end, I land at a company called Norden, which is also quite active in the tanker space. And that's how I got into it. Ironically enough, the company I first applied to was Maersk Broker. And they didn't come back to me before I actually had signed with Norden. So their, let's say, recruitment process was months, whereas in Norden it was weeks. And that made the difference. Sometimes life is a little bit random.
Yeah, that's another example of how the bureaucracy can actually you can miss opportunities because of it. Perfect example.
Yeah.
So
Mads,
look,
I didn't know that you worked at Norden, but we know some of the guys at Norden as well, and a great team over there.
Absolutely. So look, thanks for that. Thanks for sharing. We all love a good story. I love the he had to divorce his first wife. That's something that he had to do. Yeah, absolutely. But
I think, let's say it had been a marriage that was, if it hadn't happened at that moment, it would probably
happen later.
A few months later anyway.
Yeah, I guess that's the life of a sailor. Yeah. Look, so coming back to our topic of discussion. So today, we have you as a specialist of freight, but not only wet, which is what we're tanker freight, which we're normally used to, but you have a lot of experience on dry bulk as well. And so we're going to be discussing around sanctions, tariffs. Of course, that's very important when it comes to logistics and world trade. But we're also looking at the differences between the tanker market, the dry market. But and again, Neil, Michael, if you have any questions, let's jump in. But let's start obviously with this weekend we had this announcement of tariffs that seems to be like the beginning of a new trade war between the US and multiple different countries. We can anticipate probably that Europe will be next. It started off with Mexico, Canada, and China, but there's a strong chance that Europe is next, and then maybe Europe versus China. Except, well, this is a big question mark, no? But let's focus on what we already know right now, which were the sanctions on Russia and the tariffs this weekend. How is that affecting the market? Maybe Michael, you want to start with your point of view, and then we move on to Mads.
Yeah, I'll kick it off. So let's start with the Trump tariffs, just because they're so fresh. I would say that the biggest impact right now, and as we go through February, will likely be on ARA and therefore TC2s and your MRs. So I would expect, as long as these tariffs hold, up until when perhaps Trump puts tariffs on Europe, we should see buoyed strength in TC2. We should see better arb margins out of ARA into LATAM, especially compared to, say, the US Gulf Coast. And Neil, I don't know if you want to jump in on anything on there as well, but I really think when we're looking at relative landed values between the US Gulf Coast and ARA, I think TC2 and MRs loading out of that region will really benefit over the next month.
But why is TC2? I mean, I understand that gasoline going to New York would make sense because they normally import gasoline from Canada. But why should TC2 be supported into other destinations? Or tell me more about that.
So I'm just thinking that the economics coming out of the US will be worse for the refined grades. Basically, if, like, let's just say that Canadian crude that's coming into the Midwest and is being refined into gasoline, that all of a sudden is more expensive. Basically, at a high level, it feels like everything in the US is going to become a little bit more expensive. So therefore, your other sources of supply become cheaper, and those barrels coming from ARA should start to look more attractive for your LATAM importers. Okay,
I get it. And Neil, is that what you see as well on a refining margin perspective?
I think that makes sense. I think there's we have to sort of inject some nuance here. I mean, there was a lot of fear before, the last couple of weeks about what would happen to, let's say, PADD 2 refinery runs. I think particularly with a 10% tariff on Canadian imports, it's less of a problem. I think PADD 2 will keep running. What will happen is Canadian crude will get cheap. At the margin, possibly US refiners will run a bit lower. That's true of maybe the Gulf Coast, maybe PADD 2. And so you tighten up the whole balance there, right? And that includes things like you do get PADD 2 gasoline flows into PADD 1, via pipe and things like that. So if PADD 2 tightens up a bit, again, there's more of a basis for PADD 1 to import more. And where does it come from? Likely not Canada, likely ARA. There's a bit of a question, Felipe, for you just on that, so we can go off script again. Is there a spec? Is there a spec component here? So just speaking internally, Canadian guys are set up to produce RBOB, and they might less easily be able to produce EBOB. Is that a good statement in your view?
The spec issue, yeah. I mean, ultimately, the problem that US has is that they are producing too much light grades, LPG, NAFTAs and things like that, and they need to have these heavy crudes in order to compensate to produce more gasoline, more diesel, etc. So I just don't think that the question for me is not so much if they will change they still need to have these crudes if you want. I guess at some point it stops being economical, but you would need that differential between gasoline and naphtha or gasoline and LPG to narrow dramatically in order for it to compensate. and to stop looking for these heavy crudes. But as you said, I think 10% is not dramatic. I think that the question is, how is that 10% going to be split? Is it going to be the refining margins taking a hit, or is it the consumer taking a hit? I think you can dilute this into both, and not necessarily see a dramatic impact. That's my take on it, is that 10%, if it was 25%, then it's dramatic, that is big, because they're also talking about shutting the Venezuela crude, etc. So, and Mexico also has 25%. So you're stuck with no alternative obvious heavy crudes for the mix. So I just think it's going to be diluted into more higher cost for the consumer and slightly lower refining margins. And I think Goldman had a similar kind of view the other day or this morning. That's one take. I would say that, just to finalize, I think that for me the biggest impact is on RBOB, because of all the imports of finished grade gasoline directly coming from Canada, because it's basically every single export from East Coast Canada goes into New York, and it's a pricing center, and therefore has an impact.
Yeah, I tend to agree. Like, Canadian crude's just going to get refined, and it's maybe just it becomes a Canada story. Yeah.
For me at least, it is a bit like that. But obviously, but Mads, what is your take on this? What do you think?
From a dry bulk point of view,
any point of view, dry bulk or
Donald Trump, who will be the decision maker in this. I think that China's decision to focus more on Brazil for supply security of, for example, soybeans, has a bigger impact. The Chinese already stopped buying what logical amounts would say they should in the US. If they were to buy from the US, they would be much cheaper. It's a much closer supplier, especially out of the PNW. But China has, for strategic reasons, chosen to focus a lot of the purchasing out of Brazil, making sure that their money goes to Brazil to make sure there are, plenty of soybeans to go around. This year, Chinese demand is down. Market is down. There's lack of demand. Similar as that, rates are really low. And whether Donald Trump, puts a little bit of tariffs on Canada and Mexico, it's not huge seaborne volumes to and from each other. So I'm actually not too bothered about that.
Mads, what about just to keep talking about Trump then, I know that he wants to end the war in Ukraine, and with all the wheat production and other sort of grain production out of Ukraine, what's your opinion there?
I think that it will be a bit of the same. Presumably, let's say the war ends, he makes a deal, and we unsanction Russia for grains. That means that the logical buyers, the closest one, will start buying Russian grain, let's say Spain, Italy, which means ton mile will be down, which means there will be even less demand, not only in tons, but also in ton mile. Shipping thrives on inefficiencies. If you don't have any Houthis blowing up the Suez Canal, if you don't have any war in Ukraine, if there's no, let's say, weird scenarios where you have to do weird stuff, but everything is just fully logical, running on full steam, freight rates are going to stay super low for a long time.
Yeah. And that's kind of what we've been seeing on the inefficiencies. Sorry, Felipe. I was just going to say we're starting to see some of the kind of logistical efficiencies drop. Like, as you're saying, Mads, if we see fewer Cape routings and more routings via Red Sea and Suez, well, that's going to impact ton mile. Similarly, like the Panama Canal over the last 6 months, really no water or draft restrictions. It's helping with inefficiencies. Great for the product guys and not so great for the freight world.
What is interesting, though, is that once the world become, let's say it settles at a lower overall level, some weird arbitrages tend to open from time to time, simply because rates become so low that you can actually ship goods from afar. I'm not saying that Europe will start buying all their goods from Asia, but you will see some weird flows. Like, for example, we saw 2 years ago during the energy crisis, Europe buying coal from Indonesia. Now, if freight rates overall are very low, some, let's say, trades that are not normally open could open.
Yeah. And you guys were talking as well before about the impact of the strong US dollar. Maybe you want to share a bit more on that?
Yeah, of course, it's let's say it's a historical correlation that when the US dollar is strong against other currencies, importers who pay in US dollar can buy less, and that generally leads to lower demand. So if we have this, let's say, trifecta of headwinds for dry bulk, China buying less, strong US dollar, oil prices also lower, inefficiencies are getting away. There's not much left in the world of inefficiencies. It's hard to see where a meaningful rally will come from. There will, of course, be pockets of strength on a, let's say, South America suddenly has a bit of crop and it goes a little bit up there. But overall, it's hard to see where any meaningful increase in prices will come from on dry bulk.
Yeah, and in the context of, because you're talking about if there's no more Suez Canal issue, if there's no more war in Ukraine and all that, but right now we're going, I can only imagine that as we're heading into these tariff wars, you're not necessarily fighting, but you are disrupting and the flows or things like that. Are we not going to see more inefficiencies and more disruptions because of these?
It could be. It's hard to guess what the Trumpster is up to these days. Maybe something will come, but it has to really because if you look at what the trade deficit is for the US, it's not because they import like a lot of commodities on dry bulk. That's not where it comes from. It comes from semi or finished goods from China.
Yeah.
So if there is, let's say, a tariff there, it will make have a lot of impact, I think, on container ships. But for dry bulk, not really. Of course, hard to say if he goes super hard after cement industry or steel imports or something like that, then it could be. But I'm personally quite relaxed about whether this could lead to a super rally. I really don't think so. It's a very low probability event.
Okay.
I also think that it could create pockets of interestingness. Like, for example, we've already spoken some about TC2. So it's creating bullishness out of ARA and some interesting flows that are maybe not as common in the Atlantic Basin. So as Trump slowly moves around the world, ebbing and flowing with his tariff policy, we'll probably continue to see regional pockets of strength and then weakness, which could create some really interesting, good trading opportunities over this year. But compared to the classic inefficiencies of the last couple of years, it's going to be more regional than a global uplift for freight rates.
Yeah, I like that perspective, Michael. And I also think first thing just to mention, this is a good point to mention, the tariffs on Mexico and Canada are not done yet, right? Tonight is the deadline. We're recording on Monday. I think there's more talks to come today. So there's still a chance that these things don't happen, right? But if they do, then let's say on the dirty side, you've got less than 1 million barrels a day of Mexican crude that needs to be redirected. It's fairly heavy stuff, so it's more likely to go to a place like China, just for basically quality reasons. But I guess I would class that as not particularly disruptive, right? It is an increase in ton miles because Mexican is basically not going to the Gulf Coast, but it's going to China. But it's not that bad, let's say. Is that fair to say?
Yeah. I'm with you.
But then the next question, one we have to explore in the next pod, just to hijack this a little bit, is what if Europe puts a 10% or a 15% tariff on WTI? It's a way higher volume crude, and it's not out with the realms of possibility, right? Because Europe's already talking about it, and Trump is already talking about putting broad tariffs on the European Union. That would be a different story, right?
Yeah, then that's a whole nother can of worms. Then you'd start to want to look at the DPP FFA contracts like TD20 versus TD25. So your Suezmaxes out of WAF versus your Aframaxes out of the US Gulf. That would get quite interesting.
Well, I mean, Europe, when it comes to Europe's energy policy, we tend to be self-destructive. So it is totally possible that we start imposing all kinds of tariffs on the only crude that is, easily available. And so let's see. It's possible. Let's see.
At what point does everybody then just have tariffs and we're in 3 months from now, we're back to where we were 2 weeks ago?
Yeah, just more expensive. Yeah.
Yeah, everything's just more expensive.
But we didn't touch upon it just before we move on to the differences between the two markets, but we didn't really talk that much about the sanctions. We talked about tariffs, but sanctions. So we on the wet side, we know we've discussed it at length, but what is really happening on the dry bulk market when it comes to sanctions? Is there an impact or not?
There is an impact, and not to be Mr. Negative Bear, but I won't say it's a large one. Grains are not sanctions in Russia.
Mm-hmm.
You are allowed to be involved in agricultural trades out of Russia. I think Kargila, I think Bungia, I think most people are. I doubt that you are allowed to actually then send your ship to Russia and get payment in rubles and these kind of things. So a sort of, let's say, a semi-shadow fleet has appeared, but because the markets are so low, the premiums they get are 2, 3, 4, 5% above what they would for going to Ukraine or Romania or something. Like it's very negligible price premium they get. It's a bit the same with Iran. Again, it's sanctioned, but then you have some Chinese vessels that just goes back and forth, and it kind of exists inside its own ecosystem. It's also worth keeping in mind that global fleet speed is at the lowest it's ever been. So there is potential if ship owners saw, and if prices went up, ship owners could speed up to meet more of the demand. But right now they're doing everything they can to take demand out of the market.
Amazing. Okay, I was not aware. So you actually measure this on a regular basis. What is the fleet speed on a global basis? Okay, excellent.
All vessels have a tracker called an AIS signal on, which you can buy data on where you can track them. And a lot of, let's say, software providers sell this kind of data. You can aggregate it yourself, or you can buy ready-made dashboards. And one of the key metrics to track is this fleet speed, at least if you're looking on it from a macro point of view. Of course, if you're looking at only Black Sea, you only want to see the satellite signals from the vessels inside of Black Sea, of course. But on a global scale, it's a good what you call it, thermometer.
Leading indicator. Yeah, I would say.
Or what is the health of the dry bulk?
Yeah. No, fascinating. Okay. Well, look. Okay, so let's continue this discussion around the differences between the tanker market and the dry shipping market. Mads, let's start with you. What would you say are the main differences between these two markets?
It's hard to say a lot about the tanker markets when I don't know it, but from what I can observe here in Copenhagen, where we have quite a few large tanker operations and tanker companies, is that dry bulk seem to have a bit more of a merchant spirit, a bit more happy-go-lucky. You can go somewhere, you can set up a shop somewhere, and if you know a few guys and you know a guy who maybe also do some windmills, you can combine that with some grains and you stop here. So you can really be entrepreneurial, whereas oil is big business. Like Shell, BP, they've been in business for hundreds of years. I don't know how many fixtures they do or how much crude oil they move, but you need to be a big operation to get into bed with these guys. You need large ships, you need vetting departments, you need to have charter party frameworks. So I think dry bulk has a lot more, let's say, gray areas, especially the smaller the ships goes. When are you a freight forwarder? When are you a shipping company? When are you maybe some sort of like quasi broker on behalf of your cousin who has something in somewhere? And this aspect I don't think exists in oil in the same way.
Yeah, definitely oil. It's always been about big operations. It's all been a volume game, constantly bigger and bigger ships for optimization and all that. And I think I was telling you before where when I used to trade biodiesel and everyone was importing biodiesel from Argentina to Europe, and everyone was buying small clips, 5 KT, and you would talk to a supplier and he would by default sell you 5 KT. And the ships were 30 KT chemical tankers or MRs. But everyone would, put together 5 KT each, and then you would have these sort of organized slots every 15 days or every 10 days you would have one vessel coming in. And so the ADMs, the cargoes and all that, they would still operate in that way because also the demand, getting rid of 5 KT at the time was very complicated, or more than 5 KT. And then the oil guys came in and they're like, screw that. We're going to take the full vessel take $40 a ton of discount on freight, and then we're going to move the full 30K or 35K into Europe, and then we'll figure out how we sell it, and they basically took over the supply chain, the Gunvors, Mercuria, Strathis, and all that. And instead of moving away from these chemical tankers into oil tankers and thinking big, it's always been that mentality. Yeah.
It's an interesting
that makes good sense.
Because tankers, they just keep getting bigger and bigger and bigger volumetrically, but they're generally carrying just a single product. So a massive tanker of diesel or of gasoline or a VLCC, for example. But Mads, correct me if I'm wrong here, like you can get a lot of co-loading and combi cargoes on the dry side where it's different compartments, and you've got wheat or soybean, etc., and then you're discharging all across LATAM. Or how does it work?
You're absolutely right. Freight in dry bulk is like any capitalist market. You need to be bigger, you need to be better, and people are constantly looking at new creative ways of creating value for the customers. Traditionally, freight trading or ship owning has been about being in the right place at the right time. So you're sort of trading this two-dimensional thing, and you didn't really have to be that creative with what you put on board. You just had to, be there or be square. Now we're seeing, especially from the ABCD grain companies, the Cargills, the Dreyfuses, whatnot, that they want to compete in freight markets as well. And what they focus a lot on is saying, hey, we got 10 different small customers in Malaysia, Indonesia, Vietnam. Let's combine all of their demand into one big pool and then ship it on very large vessels. So individually, they would probably each be able to buy half a small ship from Australia, but pooling it together, they can have these large industrial Panamax trade flows from South America into Southeast Asia. And what this also does, and I don't know if it's the same in oil, but I could imagine is it gives the ABCD companies a lot of flexibility, because maybe they sold it into Indonesia and Vietnam with the intention of shipping it out of Brazil. But let's say there comes a trade war, or there comes some sort of tariffs, and now suddenly PNW or Black Sea or US Gulf is the cheapest place. Then they change. And this is sort of where they make the bread and butter.
That's exactly the oil playbook. It's been always, or at least it's been like that for many, many years. It's a word that actually does not belong to the English language, is optionality. I only learned that recently, that the word didn't exist. But that's basically what you do, is looking at getting those shorts and then playing with your optionality to, bring it from wherever you want. But I wonder, this is more a question for grain traders, but, in oil, you have all kinds of swaps, OTC swaps, that allow you to have financial instruments to hedge different qualities in different regions, etc., for the same product. Let's say you have gasoline in Europe, in the Med, in Asia, and the Middle East, and it allows you to hedge for these different, sites. But in grains, you don't really have that. It's like the future and then the cash diff, and that's it, right?
I am not a grain expert either, but I know a bit of it, because what we do in the CM Navigator is take the cash markets and link them to the futures market. And if we take an example of Europe for wheat, there is basically just one product. It's called a Matif down in France. And even though it's for futures delivered in France, it's what everybody uses, even for the, let's say, shipments out of Poland or into Spain or whatever. In the Black Sea, there used to be one out of Ukraine as well, but it's hard, when there's a war ongoing. So that stopped. I think it was Platts who was offering that as a swap or an index. You have the CBOT in the USA for wheat and corn as well. But between everything from Russia to the US to have more or less only 3-4 financial instruments, it creates a lot of volume around those instruments, but it also means a lot of basis risk.
Yeah, exactly. So when you're trying to do these kind of games where you have a short here, but you want to play around with a long, or the other way around, you have a long from Brazil, and then you're like, okay, let's ship it to Thailand, but actually, no, finally we decide to move it to Australia, whatever. You don't have these financial instruments that allow you to swap the basis risk from one country to the other.
Not to my understanding, though.
Yeah.
It's a bit more, I won't call it craftsmanship, but you have to be a little bit, it's not so financial. Yeah. You still need to have people on the ground and get these physical contracts. That's why all these major trading houses have a lot of marketeers, so they can capture this demand. Because if they don't have this, they just have a shitload of origination, whether it's financial or physical. But the destinations you can also take a place like Africa, where they live, I don't know, close to 1 billion people, but there's not a financial instrument for delivering anything into Africa.
Yeah, for sure. And Michael, your point of view, the main differences?
You know, I was thinking about this a bit from like an FFA point of view as well. And I don't know a lot about the dry FFA side, but like FFAs on wet, there are specific routes. And like, I know we're not talking about the products when we're talking about the routes, but you're dealing with the route sort of equivalent of basis risk. We're talking about TC2, which is Rotterdam into New York, or TC14, which is Houston into ARA. I was trying to think of the differences between the wet FFAs to the dry. And again, wet is a specific route, and Mads, on dry, is it a specific route, or is it per vessel class?
So it's a basket of routes. So let's say for Supramax vessel size, you have 10 routes, and then it's the average of those 10 routes. So presuming you have 10 ships and they're each on one route, you get the average. But what if you have 5 ships on route 1, 4 ships on route 2? And, there's a lot of basis risk or basis opportunity if you're trading with dry bulk derivatives.
Can you talk a little bit more about that? So it's a weighted volume average of vessel classes.
It's not exactly volume average, because sometimes volumes change a bit. But let's say you have 10 routes. One is called China, Japan. One is Indonesia, Australia. One is India, PG. One is Africa to Europe. One is Europe to USA, and so on. And there are 10 routes, and they each count 10%. Then one is $6,000 per day. One is $18,000 per day. One is $12,000 per day, or what it might be. And then it's the average of all those routes make up the index. And the index is
global.
The FFA settles
it's
on.
very much a global index. Okay.
But global, but with a lot of blind spots. Because, for example, West Coast Americas is not on any index. There is one in Panamax where you started in China via West Coast USA and then back to China. But in essence, it's a route from China to China.
I feel like this would make hedging quite difficult. If let's say you have a specific route that you're normally doing as a company, and you want to hedge that route, it really does sound like there's a lot of basis risk in that, because you're buying a global index then.
There is let's say you're doing Capesize and you are Vale. Then you have one route from Brazil to China, in essence. It's okay, because the route starts in China, it goes to Brazil and goes back, so you're pretty well covered.
Okay.
If you do, let's say, soybeans from Brazil to China, you're sort of okay covered. It correlates, but there's a little bit of swing. However, if you start doing Supramax or Handysize, the correlation can break completely down. So you do have a lot of risk. And that's, I think, another reason why a lot of these large commodity companies have ventured into also vessel operating and not just buying freight. Because if you are, let's just take example, ADMI, you have a lot of goods to move out of the US Gulf, out of Brazil, out of Argentina, also some out of Black Sea. But you're not super present in Australia or Africa or something like that. So if you want to protect your basis risk, you need some vessels.
Makes sense.
Michael, so just for my knowledge, so in the same way that in tanker you have all the TCs and TD routes and all that, which are traded forward, in dry is only one, the dry index, and that's it? There's only one index? Or do you have more?
So Supramax, there is one index, and it comes out, and it's called S10. And then that's it.
Okay.
It seems quite different. And I guess because I had a look up earlier at for example, the FFA volumes between dry and wet, and dry has double the derivatives volumes as wet. And I was trying to think of just why that might be, but I guess it kind of makes sense. In dry, you can carry such a wide range of products on each of these vessel classes that I guess there'd be more market participants. But it's just interesting. I didn't think that the dry market would have double the open interest of the wet market.
I think a better guess as to why there's more interest on dry is not because I think there's more, let's say, physical people doing physical moving of goods, but because in essence, if you have a global index for global transport on, let's say, everything except oil, It's also a proxy for world trade.
Fair.
Yeah.
That's
I
fair.
know there's something like, is it 40% of all volume on dry is done by hedge funds? So they probably put it into some mega portfolio model and go long cocoa beans, short dry bulk, and buy options on Tesla, and then it makes sense in the end.
Yeah.
No, and hedge funds, the number one thing they want is liquidity. They will not get into something where they cannot get out whenever they want. Having a single index is very helpful in that sense, because everyone, you don't take into account the basis risk for the traders or the physical players. But for a hedge fund, that's what you're trading. You're trading macro. But I've always heard from the outside, I've always heard that the dry market was much more sophisticated when it came to derivatives than the tanker market. That was always the theme. Is it maybe linked to the fact that you have one single index concentrating all of the liquidity versus having 20 different ones on TCs and TDs? Is that maybe the reason?
It could be. It's hard to speculate about, is it more advanced, is it not? From the chair I sit in, when I look out into the world and want to be inspired about what's going to happen in dry bulk, I look first and foremost at container business. Well consolidated business, global, super efficient, full value chain companies, for many of them doing all types of logistics around containers. Then I look next to oil industry. Also a lot of consolidation, a lot of very, let's say, streamlined processes around compliance, around counterparty checks, all these kind of things. And then sort of when I look around at where I sit, a lot of these things haven't come yet.
Yeah, it's the Wild West.
Yeah, so that's also, the thesis that dry bulk should be more advanced on FFA. A better guess would be that perhaps you have much more strict risk and risk management procedures in oil companies, whereas in dry bulk there is a little bit of it's an owner-operated shop. If the owner wants to go long, he can buy whatever he wants.
Yeah, true. I was thinking about this as well, just from a specialization point of view on tankers, and then, for example, specialized gas carriers. I don't know what the volatility is like on the dry bulk indexes, but in tankers and especially in the specialized sector, it can be quite wild. Like, for example, BLNG for your LNG carriers or BLPG for the LPG carriers. It's not like the CPP or DPP tankers can convert and then carry these specialized products. So if something happens in the Panama Canal and VLGCs and LNG carriers are not coming through, that'll have a wild effect on the specialized market, similar with other issues and geopolitical things going on in the world. But what's the volatility like on these dry indexes, Mads?
It varies. The larger the ships, the wilder the swings. Something like Capesize. I think the Capesize FFA, I read somewhere that on the New York Stock Exchange, of all the stuff you can trade, it is the most volatile product. I didn't fact check it, but I can give you an example. Even on smaller sizes, we are seeing something like from February, which we're in now, to March, a 30% increase in rates from 1 month to the other.
Wow.
I think 30% is pretty decent. I don't know what it is in tank.
It is. But, that's decent.
It's a lot. And it creates also a lot of animosity in the market, because if you're looking to buy freight as you have a freight need, you want to cover it, facing a 30% increase is a lot. So that also means that a lot of people are sort of like, okay, then let me gamble. And this can create even more volatility on its own, because then suddenly one day they need to go execute, and you go from basically nothing happened in February, which is why the market is so slow, to 20 different people trying to buy something, 30 different people trying to sell something, some FFA traders, and then, it can completely die by Friday afternoon.
Oh, we have that in common then between wet and dry. You have periods of massive volatility, open interest, and then all of a sudden, come Tuesday, a week later, no one cares anymore. It's such an ebb and flow.
Yeah, and I think that's also a good metaphor for the world we live in today, with all the Donald Trump going on in the world. Is maybe there is no good trade out there. Maybe today it's better to sit still and wait. I never traded oil, but trying to second guess what that man will do, trying to second guess what the impacts are. You can build huge scenarios models, and I'm sure they've done that in Shell and BP, but it is really one where I wouldn't want to put my, let's say, annual result on one big bet these days.
I think there's, as we were saying earlier, I think it's definitely pick your battles. I think there will be these pockets of opportunity this year, and honestly, you're going to have your head on a swivel. And unfortunately, it's going to be reacting to a lot of headline news and geopolitical risk and everything. Fundamentals will still matter from an oil perspective of where they're flowing, but if you're not paying attention, your classic trade flows from Friday to Monday will just flip. It's going to be very interesting.
But I was looking here at the table you guys shared with freight futures, and yes, of course, the dry market is, as you said, more than double in terms of the open interest. I think it's more than double. Yeah, it's almost 3 times as big. But I also noticed that the trend is actually going into people hedging more and more. Maybe the volumes increase, of course, and therefore you're naturally hedging more. But it doesn't seem like what you just said about maybe the best option is not to hedge and not to do anything. But it's probably the case. But we do seem to have a trend towards sophistication of these financial tools. Is that what you're seeing as well? And what would the market need to do in order to get more acquainted with this? We in the oil side, we've always complained that FFA is very slim in terms of volumes, and you cannot really hedge anything. What does the market need to do in order for this market to really take off?
So on the website, Mads, we need your more pure play ship owners to be involved in the FFA market. So your trading houses, your integrated majors and such, they're all using FFAs to hedge their fleet and to trade speculatively. But your more classic pure ship owners generally don't hedge as much. And if they were to start hedging their fleet of 100 ships, this would inject so much liquidity into the market and would really prove to be a game changer for the entire shipping market, from your small guys to the owners that have 250 vessels in their fleet.
And I think the way to do this is to create incentives for people to do it, because if you have routes that are only, let's say, route based, if I was a Greek ship owner and I have 100 tanker ships, which routes do I choose? Do I do one of each routes? Do I two of the one out of PG and a half of the one out of US Gulf? It's hard to say. And there I think dry bulk is a bit easier to comprehend as a ship owner.
That's true.
It's an average of everything in the world. I have an average fleet. Well, that adds up. Super duper.
You're right.
Yeah. And I think another thing that goes along with the growth in futures is also risk management. I think this is something that's, after 2021's and 22's super rally, I think a lot of company has gotten their eyes up for, okay, we need to think a little bit differently about this than just let's buy some physical freight or, call someone we know. We need to be ready on all fronts if a storm is coming. And I think this, let's say, risk management focus ties into something called financialization of markets. It happened in grains over the last 10, 20 years. It happened in oil in the 90s. Now it's coming also to freight markets to a higher degree, probably driven by consolidation, maybe also a bit of a digitalization. It's easier, with one click of a button, I can buy a Sparta subscription and I can see a lot of different values that will enable me to actually make an informed decision. This was not possible 20 years ago.
Yeah, no, that's true. The digitalization is definitely informing people, and ultimately the more informed you are, the more confident you are in your decisions that you make, and it's a learning process. But shipping has always been a bit slower in that. But I wanted to, you mentioned something before about the lack of impact of the Trump tariffs, in the sense that some of the freight flows are almost fixed, like Brazil to China. Now, in our market, in the oil market, you do have a lot of weird movements. It's like, it's, for example, WAF is a destination for gasoline and diesel, and the origins can be, you can have 10 different origins, and they can move all the time throughout the year. So that sort of arbitrage is the best proxy for demand that will tell you the story of, what are the trade flows going to be. But so you mentioned that sometimes the freight is so cheap that you can have these weird trade flows, and at the same time you also said that the Trump tariffs sometimes make these countries say, you know what, I'm just going to buy from Brazil and that's it. How is the dry market being? Can we say the same thing about arbitrage being a proxy of demand, and how those arbitrages, open, close, have an impact on the dry market?
I think overall, yes, there are many similarities. What you point out is definitely one of them. I think some dry bulk commodities, let's say eggs, is closer to grains than many others. Companies like Dreyfus or Cargill, they've been doing this for 100 years. They have a lot of people who used to be ex-BP or Shell, so they have the same, let's say, the same book they read when they train their trainees on what is an arbitrage, what is a basis, all these kind of things. However, I think some commodity flows, cement, some types of steel, various types of minerals, are much more fixed in their, let's say, trade flows. A few years ago, a huge mine opened out of Guinea, down in West Africa, loading bauxite onto Capesize carriers. There's only so many places in the world this can go. The mine needs to keep producing. And I think whatever Donald Trump do will not impact the flow like that. Like USA is important. It's a huge exporter of primarily agricultural products and a bit of pet coke out of the US. But I don't think it's it's the impact on the tariffs is going to make on dry bulk. It's not going to affect it the same way. I think that USA is the country to watch when it comes to oil. I think USA has a much bigger impact on oil markets than they do on dry bulk markets.
Okay, well, thank you for that. Any questions on this, Neil, Michael?
No, I think that makes a lot of sense.
So
Yeah.
I like to, maybe last questions, the last topic, if you want, would be around emissions and regulations, if you want, or the regulations around emissions. How are those affecting, all of the regulations that we're seeing? How is it affecting the dry and tanker market? Is it affecting in the same way? What are the main differences? What can we talk about on that subject?
I can start on that. On the tanker side, going back, say, 2 or 3 years ago, I was quite concerned how all of the emissions would get integrated into the ecosystem of freight trading. And from the logistics point of view, on the trading side, it hasn't been as big of an issue as I thought. For example, EU ETS is generally built in as a cost into world scale. So let's just say world scale points are 1 world scale point higher than they were 2 years ago, because now that cost is built in. But it has created this need, as Matt was talking about technology earlier. There are some companies now where they really track all of your fleet's emissions. You can go in and it'll have your fleet in the dashboard, in each of your vessels, speed and consumption, and what your emissions are. Because now it's really on you to track that, because you're going to have to provide these credits at the end of each accounting year. And it's the tracking of some of these emissions for regulatory purposes that I think is quite difficult compared to the actual now, say, trading of EU ETS or the trading of FFAs. What do you think, Mads, on dry?
I think you hit the nail. I think if we go back to the 3 points, the digitalization, the financialization, and the consolidation, EU ETS and Fuel EU Maritime is a driver of this. Many shipping companies now are forced to engage in financial products. Before, they could live without hedging their fleet or hedging their bunker exposure, but they have to pay this EU ETS, which is a financial product. So they have to suddenly set themselves up with KYCs and a different kind of banking setup. And then I think the jump to starting trading futures or whatever is quite small. For dry bulk, there hasn't really been much of a market impact, except that, of course, it's gotten more expensive. Compliance is mandatory. But unlike oil, where there can be certain arbitrages in doing ship-to-ship transfer operations, the mathematics of it on dry bulk doesn't add up at all. If you have to stop by, let's say, Morocco, offload the cargo, sail away, charter in a new ship, go into the berth, load it again, you can add $10 per ton to your freight. And even if EU ETS is a little bit expensive, it's maybe $2-3 on top of your freight rate. So the math means that, as far as I'm aware, not a single ship has, let's say, avoided this fee by being creative.
Yep, I'm with you on this. I have one follow-up question then. What about alternative fuels? So with this focus to reduce emissions, like on tankers, we're seeing a lot more eco-friendly ships, but also ships and classic sort of tankers that would generally burn bunkers or have a scrubber. They're now being fitted and sometimes even retrofitted with systems that burn LNG, for example. Are you seeing anything like that on the dry side?
I am not aware of any, let's say, really large-scale projects where they do it for hundreds of ships. There are then they do 6 ships for some sort of special project, but keep in mind there are roughly 15,000 dry bulk ships. It will make sense for certain places, let's say Singapore, to be able to supply LNG, green ammonia, whatever it is, for vessels that only sail to, let's say, Brazil, back to China, to Singapore again. For vessels, let's say Supramax and down, I haven't heard about it. We have a new building series coming. We equipped it with traditional fuel. We spent probably half a year analyzing all the numbers, all the values in this, looking at all scenarios. And the best we could come up with was, well, we build a traditional ship, but we slap on a battery so we can, bring peak load down and stabilize it a bit. But it just takes 10% off the consumption. So instead of, let's say, 10 tons per day, then you're down to 9 tons of fuel per day. That's not going green. That's just efficiency. I think a lot of people are doing efficiency measures, putting sails on, doing whatever, but not really anyone where they are rethinking the ship for the future.
Understood. Thank you.
Just before we wrap up, it's a fascinating conversation. Again, Mads, thanks for joining. We always like to finish with our sort of market outlook. What do we see going forward over the next months? So, maybe Michael, what are your sort of views of the market going forward? And maybe Mads, you can share yours as well.
Yeah, so it's a tough one. Everything is changing so quickly, but at a high level, I know we've spoken about this at Sparta a lot, but for example, the Russian sanctions, I think, will have a much more muted impact than what maybe the market was thinking a couple of weeks ago. And as I've mentioned before, not so much on this podcast, but I think Trump would really need to go after the actual individual ports and port companies in China and India for there to be a material DPP impact. But watch for those headlines. If he really does go after it, then I think DPP routes, TD routes could explode higher. On the CPP side with these tariffs, like I said, right now, Atlantic Basin is really interesting. We're seeing last done TC2 fixtures be 30, 40 world scale points higher. People are realizing that the trade flows are changing and more barrels might come out of ARA compared to the US Gulf Coast. Continue to watch the headline risk as these tariffs roll out through the rest of the world. And then Neil, on this next one, if you want to chime in, I know that generally turnaround season in the US and in Europe, they come out at slightly different times, but it's generally towards the end of Q1, beginning of Q2. So we could see even more volume coming out of Europe over the next, call it 6 to 8 weeks or so. So for me, you got to keep your head on a swivel, and there will be pockets of regional FFAs to trade, I think, over the course of this entire year and probably the entire Trump presidency, for better or worse.
Mads, what's your take on the market, the next trends?
I think that the point about pockets of volatility is true. World is not going under. It's just not great outlooks. Cargo volume growth is flat. China is, going nowhere. Fleet grows up. More ships was ordered in 2021-22 than in a long time. They're being delivered now. And then you have all these inefficiencies in the Red Sea and Panama Canal and maybe even Russia, Ukraine disappearing. On top of that, you have the container market, which could also unravel. There's around a 4-5% spillover of cargoes that could be shipped either on very small vessels or on container ships, if they all get taken by container, that's a 5% demand gap for smaller ships. So I'm not super optimistic, but we are traders by mindset. So what you have to think about is what is the opportunity here, and if market have already priced all this in, what do you do? Do you go short something that is super low? Do you go long something you don't believe in? Nah, not really. So I think it's a wait and see. I think maybe Donald Trump will prove me wrong, and maybe it will have a big impact. I hope, at least for so there will be something to do this year. But I think I'm fairly bearish for dry bulk this year.
Okay, Neil, anything on your side that suddenly you've become an expert in shipping that you want to share, or?
No, I maybe just two sort of general comments, and one that Mads sort of brought up earlier in the pod. The one is that, and I guess it's that we discussed this in the last week's pod as well. Maybe it's worth having scenarios in mind. So I think we said again, if we get another 100 vessels put on the sanctions list, is it a rinse and repeat? I think we basically said it will be, because nothing has fundamentally changed. What do you need to do in order to actually crush Russian volumes? So that's the first thing. And then the second thing is, it's obviously very difficult to trade, but you can look for things that are obviously unsustainable. And one, again, just to plug something that we said last week, which has worked out over the last couple of days, for example, was the difference in the strength between the Brent and the Dubai market as a result of panic buying, right, following the sanctions announcements. And Dubai and sort of Middle Eastern spot crude was so strong that you basically crushed the margin in Asia. So it's completely unsustainable from that perspective. And that's why we said, okay, well, naturally, more west of Suez crude needs to flow to Asia because that's cheaper. And, just those kind of trades where you think, okay, this is obviously far overstretched. And given that we know that the sanctions impact is actually less than feared, this seems to be the obvious direction for the EFS, let's say. So I guess that's the way forward. You're looking for when things are really overstretched, and you're quite sure about various components of the trade.
And Neil, just to add one thing on that, I think like you're talking about Brent versus Dubai, I think there'll be a lot of relative trades. So if if Europe reacts and puts tariffs on WTI, for example, there's going to be a lot of relative value trades in DPP FFAs, for example, as we spoke about, Afras in the US Gulf versus Suezmaxes out of WAF. And I think these sort of opportunistic trades could be happening quite frequently this year.
Okay, guys. Well, this is let's wrap it up here. Mads, thank you so much for joining. It's been a pleasure getting to know you and also getting to discover a bit more the dry market. Thanks a lot, Michael, for setting it up. Yeah, Mads, you had a question?
No, I actually have a comment. Because now we spend a lot of time talking about what is different between different markets. But one of the things when I hear you guys speak is some things are the same. A lot of things are the same. And in the end, I think what it can be boiled down to is those people living in commodity markets need customers. Those customers want something, they want it cheap, they want it fast, they want it without a hassle. And I think no matter whether you do oil, tankers, dry bulk, you need to have customers and you need to service them. And I think if you're sitting as a trader doing 10 different scenarios and you don't really know what's going to happen, then chances are your customer is probably having the same problems. So maybe it's also an opportunity to think a little bit differently about how to engage with your customers.
That's a fair point. That's a good argument, yeah. Well, let's leave it there with that in our minds and how do we address that issue. But thanks again for joining, and hope you enjoyed this format. We're going to do more of these interviews on a regular basis. And yeah, thank you very much, guys.
Thank you.
Thanks.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.